Hello, I'm Russ Mould, AJ Bell's Investment Director, and in this latest edition of our regular markets review, Breaking the Mould, I'm going to try and talk about Brexit as little as possible, and I'm going to look at houses, shopping and jobs in particular. All three of them are capable of causing a fuss in the week ahead because on Tuesday the 5th of July we have a trading statement from Persimmon. On Thursday the 7th we'll get a first quarter update from Marks & Spencer, and also on Thursday the 7th we'll get a first half comment from recruitment giant Robert Walters. So, let's get going with York-based FTSE 100 firm Persimmon. The house builder's shares took an absolute pasting in the 2 days after the UK's vote to leave the EU, plunging 39% to just less than 13 quid, amid fears, as yet unproven, that a recession may follow the decision to withdraw from the economic bloc. That left Persimmon shares at their lowest level since late 2014. This leaves us looking forward to that first half trading statement on 5 July, where the key metrics to watch are as follows. Forward sales, which were 1.7 billion at the full year stage. Legal completion volumes, which were up 8% in 2015. And average selling prices, which rose around 5% to 199 grand in 2015. This graphic here shows the trend in annual volume and annual selling prices at Persimmon. As you can see, they've both been very strong. So let's see if they continue as the effects of the Help to Buy ISA, Lifetime ISA and low interest rates come up against Brexit concerns. Also watch for an update on the company's cash return programme. Persimmon's planning to pay out £1.10 a share a year to shareholders for the next 5 years, a not insubstantial figure compared to the share price as I sit here right now. The shares had been going nowhere fast for a while before the EU vote though, as the valuation had been looking full at more than 2.5 times historic book value, or net asset value, or NAV, though that's since come down to around 1.6 times. In addition, the market may have been taking the view that news flow in the form of government support, low rates and tight supply and demand meant the news for the house building industry could hardly get any better. And if it can't get any better, then it can only get worse, and if it gets worse, then the shares could be at risk, given historically lofty multiples of book value. Or so the market theory goes. Let's see if the investors now reassess the shares after the trading statement, now the stock's been clobbered. Another stock to suffer a shellacking in the wake of the Brexit vote was FTSE 100 retailer Marks & Spencer's, which dropped by more than a fifth to 285 pence in the first 2 trading days after the vote, their lowest level since 2012, and a figure that's intriguingly a fair way below the £4 a share bid launched by no less than Sir Philip Green more than a decade ago. New boss at Marks, Steve Rowe, well, he's still grappling with how to re-accelerate earnings at the high street giant, which earned less in its last fiscal year than it did a decade ago. The woes of BHS and Austin Reed show just how tough the high street is, as retailers must satisfy internet-savvy, price-sensitive customers while juggling the impact of sterling's recent drop and the living wage on their cost bases. Rowe needs to get the online business growing faster and sort out the general merchandising arm at Marks, so the first quarter trading statement on July 7 will be an early test of just how big a job he's got on his hands. Food recorded a 0.4% like-for-like growth in the final quarter of last year, but general merchandise, clothing and home, posted a 2.8% drop, though at least that was better than the 5.8% slump in Q3. Further improvement here would be welcome, a re-accelerated decline less so, and this chart shows the trend at general merchandise back to 2011, and it's not been pretty. According to analysts' consensus, M&S trades on a forward PE of barely 12, a big discount to the market, with a prospective dividend yield of nearly 6%, a big premium. That might intrigue value hunters, especially if they think Rowe can get profits growing again, but the market seems to be sceptical given how the shares have been performing even before the Brexit vote. Let's see if the Q1s give us a clue as to whether the market or the analysts are right. Finally, on the same day as M&S, Thursday the 7th, we got a first half statement from recruitment specialist Robert Walters, another stock that took a battering following the referendum vote, although it had again been struggling for a while before that, as we can see here. This should be a really interesting one, as April's first quarter update had flagged good growth in the Asia Pacific and Europe regions, but a slowdown in the UK. As this final graphic shows, at the Q1 stage, fee income in constant currencies was up 13% in Asia, 12% in Europe and just 2% in the UK. Boss Robert Walters cited an ongoing slowdown in the UK, especially in financial services. Whether that was down to Brexit worries or a deeper economic malaise remains to be seen, and Walters did say it had actually seen an improvement in March, so let's see if that continued or not. We live in interesting times. Thank you for watching, and I look forward to seeing you next time.